So I have an urgent message today, and it's about the inflationary future that awaits us. And we know the economy isn't doing well, and the markets are starting to implode under the weight of high interest rates. But don't lose sight of this. The US national debt is now $33 trillion strong, and this is insane. In fact, we should all be concerned about this because this insanity can't continue forever. The end game of this deficit spending is going to be massive inflation down the road, and we are on a fiscal path to economic hell. And every time the national debt explodes up, it just means two things. A lot of money is being spent today to keep the economy afloat, and this borrowed money will have to be paid back with interest. And this is the immutable law of gravity. And if you try to break this, you'll collapse the entire global financial system. I recently read an article about Janet Yellen acting real casual about the debt crisis. She isn't worried and believes that this state of affairs can continue. And this is simply downright bizarre. And I need to call her out on her crazy statements. According to her, everything is fine. And here's what she said: the statistic or metric that I look at most often to judge our fiscal costs is net interest as a share of GDP. And even with the rise we have seen in interest rates, that remains at a very reasonable level. Remember, this is the same person who said inflation is transitory, and we have to challenge her statement because it obscures the truth and the gravity of the situation. Sure, in 2022, the interest payment is still below 2%, but that obscures a daily reality. A huge part of the GDP in the United States today is driven by government spending. In 2022, 37% of GDP came from the US government spending itself. In 2020, this number actually came in near 50% when the Federal Reserve injected tons of money to stimulate the economy. Janet Yellen believes that the debt will always be fine as long as GDP rises faster than the interest payments. And the only way to guarantee that is to keep government spending up, which is absolute insanity. And I'm quite confident that when the numbers come out for 2023, government spending will easily exceed 40% of GDP. And this reveals why inflation is the name of the game. The US government has to keep spending up to artificially increase GDP so that for the time being, interest payments on the debt looks insignificant. But there's even a problem with that. According to some estimates, interest payments have jumped to 3.6% of GDP in 2023, and because of high interest rates, this number is shooting up despite government spending staying high. And this is unsustainable. Sooner or later, interest rates have to come down significantly or the debt will spiral out of control. And let's take a step back and look at the bigger picture because deficit spending probably won't go down. In fact, Yellen can't afford to borrow less money. Right now, the United States is fighting two economic wars with Russia and China, and wars are very costly. Sanctioning Russia has unleashed energy inflation. Putin is cutting oil production and it is causing massive price distortions. Then you have trade restrictions on China and friendshoring, and this is messing up supply chains and making the cost of imports more expensive everywhere. America is trying to reshape the world to their liking and throwing hundreds of billions of dollars, even trillions, at the problem. And all that is to prevent inflation from going down, even though the Federal Reserve has hiked from 0 to 5% interest rates. And this is a battle for Germany that they can't really afford to lose. If they lose this, a lot of bad things can happen just on the economic front alone. So I'm supremely confident that the Federal Reserve won't let the US bond market collapse because if it crumbles, America can't borrow money any longer. And let's recall the recent debt ceiling debacle back in June, the one where Biden lifted the debt limit. He basically suspended it, allowing the United States to borrow as much money as they want until January 2025. On one hand, you can call it reckless, but on the other hand, it's pure pragmatism to keep the US Treasury market alive. And let's put on our thinking caps and dive deeper. If President Biden didn't sign the bill, the US would default on their debt, and this would create chaos that has long term consequences. Countries in the short term might rush towards dollars because of a big shortage, right? But they wouldn't trust US bonds anymore down the road. And back in 2022, Zoltan Poza of Credit Suisse predicted that this geopolitical battle would go from bad to worse. He wrote a very prophetic paper regarding Bretton Woods 3, the birth of a new financial order. And at the end of the crisis, the dollar will be much weaker in buying power. And this is a little complex, but I'll try to simplify it, so bear with me. In order to counter Russia and China, America has to spend money to do four things. They have to rearm themselves, reshore their supply chains, invest in commodities, and achieve energy independence. And all of this will require lots of deficit spending, which also means issuing a ton of bonds. And according to Zoltan, this will require rates to come down to reasonable levels. And that doesn't mean we'll hit 0 or 1% Fed funds rate, but rates can't stay forever at 5 or even 6%. It will push America closer towards a fiscal cliff, then they will really default. And if they default, they will lose the economic battle. And one great example is the $280 billion bill, the CHIPS Act, which is basically a strategy to counter China. That is a form of reshoring their supply chains back to American shores. And 280 billion is a lot of money, and they can't keep this spending up at 5 to 6%. In other words, rates have to come down to allow the United States to borrow money to defend the current world order, defend the current system. So you need to be in the game. You have to think long term and realize that the final destination is the inflation roach motel. We have checked in and we can't check out. But let's zoom into the markets themselves, right? The big geopolitical game is just one aspect. Investors themselves are going to push the world towards an inflationary future. Right now, bond yields for US Treasuries are extremely high, especially on the short end of the curve. We can see yields on the 3 to 12-month bonds pushing near 5.5%, and that is an insane amount of return for doing absolutely nothing, guys. You get 5.5% risk-free, and consider this fact. The average return of the stock market, the S&P, is around 9.8% a year, and with bond yields that high, the average investor can get over half the returns of the stock market without taking on any risk. In fact, high yield bonds today are giving out 8.6%, but people aren't interested. They are not chasing yield because the risk-free rate from treasuries is over 5.5%. And let that sink in for a minute. And that's why investor money is pouring to money market funds like no tomorrow. In 2023, investors have poured $1 trillion into money markets because investors want to enjoy a higher yield with zero risk. It's not really rocket science here. And a big shout out to our sponsor, Private Internet Access. We know the importance of keeping our investments private, but are you doing the same for your data? Now, using the internet without PIA is like having your password televised to the whole world when you type. Anyone can sneak a peek, access your private accounts when you are asleep. Online browsing today is getting more and more dangerous. You don't want your identity stolen and definitely not your financial information. And this is why having a VPN is just so useful. PIA helps to hide your IP address and encrypts your internet connection through an encrypted server. And this helps your data, your activity, and what you invest in confidential. And what's awesome is how PIA protects all your devices. It's available for Windows, macOS, or Android, and there's no limit to the number of devices you can use it on. PIA covers over 84 countries, including every state in the US, so you can access more content than ever before. Just one click and you're good to go. Best of all, PIA is risk-free. There's a 30-day back money guarantee and 24/7 customer support. So you can get started with private internet access and get an exclusive 83% discount using the link in the description below. You also enjoy 4 months for free for just being a valued subscriber to the channel. So check them out and get protected today. If we look at the amount of capital in money market funds, it has hit a staggering $5.64 trillion. As commercial banks continue to lose their customer deposits, these funds are increasing their holdings to insane levels. And this is money that will eventually flood back into the markets. And this is why I need to use the dam analogy again. I want us to picture all the money in US treasuries and money market funds as water stored behind a dam. As people buy more US bonds, this is building up more and more potential energy. Remember that this money is also accumulating interest at over 5% a year, and this is creating a huge amount of stored energy just waiting to burst out. And what do you think will happen once the Federal Reserve starts to lower rates? All this built up energy will explode out and flood the market to chase returns. It will flow into a ton of assets like stocks and gold, so the end result will be inflationary. Even though the Federal Reserve is draining away liquidity today, this money will eventually flow back out to the markets. And here's the hilarious and the tragic part. Paying interest on the debt will likely be borrowed into existence as well, right? So you're taking on new debt to pay off existing interest on the debt so that the current debt bubble doesn't explode. No matter how I wrap my head around this, the final destination isn't Disneyland, it's Inflationville. And I believe the Federal Reserve will cut interest rates sooner or later. You can't stay at 5.5% forever. The interest payments will explode and the national debt will implode. Even Goldman Sachs is forecasting rate cuts in Q4 2024, so around 12 months from now, this could be the trigger event for either a market collapse or the beginning of an inflation hell. And here's the truth, we don't know which scenario might play out in the short term. This doom loop of endless borrowing and high interest rates will end one way or another. And we know the classic collapse story. Everything implodes and the Federal Reserve panics and starts printing money again, and that will revive higher inflation. Simple enough, right? But let's talk about the other scenario. What if the economy doesn't collapse? Are we prepared for such a possibility? Because it technically could happen if all the stars align. And we must explore this scenario. It's possible that the Federal Reserve proactively lowers interest rates without the markets imploding. During the recent FOMC meeting, the Federal Reserve reviewed their forecast chart, which basically tells us where Powell and friends view interest rates going forward. The majority of the FOMC sees interest rates slowly tapering down from 5.5% and it will stay at 2.5% in 2027 and beyond. And this is a big revelation that tells us a lot. They are hinting towards that inflation will still be a long-term problem. And that's why they are projecting interest rates will stay at 2.5% or higher for years to come. And this could also mean that the Federal Reserve has given up on its 2% target and long-term inflation might stay at 2.5% or even 3%. And this could be a sick version of a soft landing, right? I'm not saying that we'll avoid a market crash, but it is possible that the government spending keeps the economy going at the expense of a weaker currency. Interest rates have to come down, and we have to prepare for what happens next. We must prepare. The problem with America's balance sheet is simple. They are spending much more than what they are taking in. Deficit spending is going up while tax revenues are coming down, and this is a big problem. According to the Brookings Institute, income tax receipts are crashing back down to the 10-year average of 9%. Government collections have fallen from 13% of GDP down 4%, which is a big drop. If your earnings are coming down, you can only control what you spend. But if you need to keep spending and spending, the only part of the equation you can control is the interest rate. You can't increase the income tax rates, not when next year is the election year. So even if we don't get a hard landing, inflationary pressures are already building in the system. And I think many of us don't dispute the inflation endgame. What we disagree on is if a market crash could happen, but no one really knows, right? If we look at the GDP estimates from the Federal Reserve, we get a shocking number. They somehow believe US GDP for Q3 could come in at 4.9%, while mainstream forecasts are putting it at 3%. And here's why. We could have one part of the economy collapsing, but another part booming from government spending, right? And the net effect is still GDP growth at the expense of a dying currency. And that's why we must invest. We have to acquire assets for the long term. Look 10 years, 20 years, or even 30 years beyond today. If a market crash happens, great, you can buy stuff on the cheap. But the thing is that we really don't know if a collapse will happen. It's not 100%. And that's why even today, I'm still buying stuff like gold and stocks. There's a tsunami of money in treasury bonds building, and it's money just waiting to burst out once people realize the obvious that inflation is still a problem and getting 2 or 3% yield on bonds isn't enough. You are still losing buying power. So here's how I invest. I'm 40% into money markets today. Every $100 I get, I plow 40 bucks into short-term bonds because I'm getting over 5% risk-free. I'm instantly in the green. And if the market crashes, I have a ton of dry powder to scoop up assets at discounted prices. I'll be buying hand over fist like there's no tomorrow if prices collapse. But 60% of my allocation is into a mix of stocks and gold, and here's why. Gold is pretty simple. It is a store of value, and there's a massive bid from the BRICS nations like China looking to de-dollarize. Even people in Japan are rushing towards gold because their buying power is getting destroyed. So if we look forward, as the dollar gets hammered by the global south, gold will likely benefit. But I still buy stocks, I still accumulate equities, and it's not really that I believe valuations are fair and that I'm getting a good deal, but because we just don't know how long this party will last. There has been a lot of money printed since 2008, and let's not forget that from '08, almost $8 trillion were pushed out into the economy, and a lot of that money has beaten up stock prices. Now, even more money is being borrowed and built up as we speak. A recent Gallup poll found that 61% of US adults own stocks. The stock market is the first and the last place most investors go to. It is their default avenue to run towards when conditions change. You need to have a game plan because high interest rates won't last forever, it won't last for long. And regardless of whether the market collapses or not, inflation is still the end game. And that's why, even though cash is yielding 5%, inflation, guys, is still the big enemy. The US government can't afford for interest rates to stay high, and the Federal Reserve will have to lower them eventually. The Fed has two tools to influence the market, and both of which are long term inflationary. And the first is to set the Fed funds rate, the second is to buy bonds to push yields down, also known as money printing. And whichever they do, the long term effect is allowing credit to flow while encouraging more risk taking. Sure, in the short term, that sudden shift could crash the markets because people might just freak out, right? But once all that cash in the money markets and bonds work its way back into the system, back into the markets, asset prices will rise and reach new highs. There's no going back. This clown economy is all about inflation. But let me know what you think in the comments below. How much more money can the US Treasury borrow? And when will the Federal Reserve slam rates down? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.